Hi, and thanks for joining us. My name is Andrew Grant, and I'm the Director of Manager Research and Investment Solutions here at Kayne Rudnick Wealth Advisors. And I'm joined today by two of my colleagues, Senior Wealth Advisors, Kevin O'Regan and Sam Waltman. Today we're going to talk to you all about behavioral finance and some biases that clients and investors over the years have had to deal with and have really seen underperformance versus the markets, and what those behavioral tendencies or biases have led to that underperformance. So we're going to walk you through what some of those examples are from an investment standpoint. And we're also going to talk to you about client situations that we tend to see. But if we start off, generally speaking, how the retail client has done, there's a very noteworthy study called the Dalbar study, where over the past 30 years, retail clients have underperformed a US index like the S&P 500 by almost 40%. And that's a considerable amount. And it just goes to show that even though the S&P 500 is not the total investable market, it's the one that most people tend to look at. So we're going to define what some of the behavioral biases are, and we're going to start off with loss aversion today. Loss aversion is when clients tend to feel the pain of losing more than they do feeling the gain of having better performance, right? So it's fear of loss. And Sam, if you're thinking about what a client deals with and how you talk to them about loss aversion when they come to you with situations, do you have any examples that you can think of right now for us?
Yeah, for sure. I think one of the big areas where loss aversion shows up with my clients and my conversations is a lot of the clients we work with are in retirement or nearing retirement, and there tends to be almost a knee-jerk reaction toward becoming more conservative as somebody hits retirement, and it's understandable. And that may be the exact right reaction for a particular client to become more conservative, but we would prefer to be making that decision based on an all-encompassing financial plan that considers all of their goals and objectives, as opposed to just kind of a basic rule of thumb that I need to be more conservative because I've retired. So that's really an area where we see it a fair amount. Another, job of ours as advisors is just, around educating clients around the fact that if you're participating in the markets, you have to expect volatility, and you have to expect there's going to be losses. And so, we try to, educate on that. And also, here at Kayne Anderson Rudnick, reminding clients about the importance of investing in high quality as a way of mitigating that downside volatility.
Yeah, we know it can be scary, but we try to smooth out that volatility for them. Kevin, I don't know if you had anything to add.
Yeah, Sam made some great points there. I think what's always interesting about behavioral finance as a topic is when you think about some of these biases, they can actually cause investors to do different things depending on how they're feeling, right? So that particular bias, not only can it cause somebody to basically be overly conservative to avoid a loss, it can also cause an investor to want to double down on something that's sitting at a loss in their book, right? And so it's another way that these biases basically filter into decision making, right? And it can actually cause someone to say, okay, this stock is down 50%. I don't want to part with that stock because of where it was a long time ago. But frankly, that information is sort of irrelevant to them.
Yeah, it's almost like a bias on top of another bias is what tends to happen, and you exacerbate the problem, right? And I think a great example that we just saw with the volatility in the markets during the tariffs in April was we did see some clients, very few, it's about 2 or 3 of them, actually sell at the bottom, right? And now look what's happened, right? So it's those tendencies to worry, not understand that the markets are going to fluctuate. We understand that those are scary times, but that's why we're here. We're here to help you out. And if we're moving on to the next bias and behavioral characteristic that we'll see with clients, recency bias is another one, right? It's really taking what has happened most currently in the market or chasing that sort of hot stock, right? Making the decision that it's almost hurting right? You're just sort of going with the flow, and you want to chase, right? Can you tell us a little bit about what you're seeing from clients with that?
Yeah, I mean, I think recency bias can manifest itself differently, but typically when we think about this bias, it's typically investors kind of gravitating towards, what has worked recently, and think about where we are this year. If we think back to the conversations we had with clients last year, clients were saying, why do we own international stocks? Why do we own emerging market stocks? And here we are, right, in a period where the US dollar has weakened dramatically. International and emerging markets have done incredibly well this year, right? So it all comes back to, we don't want clients kind of chasing whatever the hot sector or hot dot is of the day. We want to build a portfolio that can work in a variety of markets, right? And that's the idea. So we're trying to combat that bias through diversification, being disciplined, and providing updated guidance over time. That's the idea.
Diversification can look tough at times, right? But it's really important, and that's what we preach. And these are the times that you will see that come out in the portfolio. Sam, on that, I don't know if you had anything else.
Yeah, I think it's an understandable one, because I think whether it's at a cocktail party with friends and family, or whether it's you turn on the financial news, there's just a disproportionate amount of airtime and coverage on the things that are working well. So you have to kind of think about that, and really, in some sense, in many instances throughout history, a better approach is to say what is not working well, and making sure that you've got an allocation there, because we all know that times change. So as Kevin touched on, I think diversification is kind of the key to it, and making sure that we at a base level, we want to make sure that clients are not caught off sides. If they're really concentrated or piled into something that's been working very well, that's going to feel great now, but we want to make sure that they're covered for when that changes.
Yeah. So I get why these types of biases happen, and they can absolutely lead to people chasing. And then when that volatility comes back in, it's complete nervousness. Yep. So, and if we're going to touch on the last bias here, right? And again, remembering that the markets change, the markets evolve. Anchoring is really this third bias that we see, right? And anchoring is really, you anchor yourself to a specific price on a specific stock, right? Or you have a dollar amount that you have to hit, right? And it just creates this noise in the way that you invest. And Sam, for your clients, how do you see anchoring being a headwind for them, and what do you do to help them out?
Yeah, I think, what's interesting about all three of these biases that we've talked about is, I think they're all just ways that human beings create mental shortcuts, right? Because if we face the reality, investing is incredibly complex. There's so much information, things are constantly changing. So we're trying to grasp onto these kind of mental shortcuts. And, anchoring, one of the, as you said, I think one of the ways that I see it is clients may feel like there's almost kind of like a paralysis when you see like the market come down, let's say, and you were used to opening your statement and seeing a certain value, and all of a sudden it's below that. Yep. I think I've seen clients that maybe become sort of they don't want to make any changes until they get back to that prior level or something. And so that can work both ways, where maybe they're really, if they were thinking about things on a go forward basis and not just thinking about the past, then they would make different investment decisions. And so it could just lead to suboptimal allocations and maybe not being dynamic enough as conditions are changing.
Kevin, I don't know if you had anything to add that you're seeing from your clients.
Yeah, I think two great illustrations of how this bias comes into play, right? Sometimes it comes into play when people feel locked into a position as a result of, I have this huge embedded gain in this one stock. I'm loath to sell it because of the tax consequences. Or as Sam pointed out, sometimes we do hear that from clients where they say, I'll get back on track with my financial plan once I hit X amount of dollars. And unfortunately, investing just doesn't work that way, right? The market doesn't know that you're looking to hit that arbitrary figure, right? And get back on track. So there are a number of ways that this comes into effect. The other way is, if you think about it, sometimes investors, and again, this just goes back to the impact of mainstream media. If you're watching every day and you're trying to pick a sector, right, you're going to have that opportunity, because they're going to do that every single day for you, right? They're going to talk about the hot sector, the hot stock, what to own. Think about COVID timeframe, right? Think about the shape. If you look at a chart on a lot of those sectors, right? Think about like home retailers. we all thought, and this got pulled into corporate earnings, right? Everyone thought we would be home, sitting there, pushing buy on these home retailer sites until the end of time. And guess what? Like, that is not the way that things worked out, right? So you get these periods of time also where you get all these earnings that get pulled forward into the stock. And guess what? That old stock price, it's really not relevant, right? So anchoring can also factor into you're anchoring to older pieces of information, irrelevant stock prices, right? And that's the discipline that not only financial advisors bring, but portfolio managers and analysts, right? And I think that's a real advantage at our firm. We have all that intellectual capital where they're constantly reevaluating new information. I think that's huge.
Yep, it's a constant process for us, and that's what we hope that we're here to help our clients with, right? So if we're, again, sort of going back to these three biases, and you all are here to help these clients, right, make good decisions, not just from an investment standpoint, but also from a behavioral, standpoint. And, loss aversion, recency bias, they're some of the more common ones that we see. And we really hope to help our clients out with that. Well, I think we learned a lot today about some of the behavioral biases that we see in financing, and none of these are easy to overcome. We understand that, but we are here to help, and that's what we do with our clients here at Kayne Anderson Rudnick Wealth Advisors. And I want to thank Kevin and Sam for your time today. It was great learning about what your clients are facing and some of the uphill battles that they have when it comes to behavioral finance. So if you have any questions, please don't hesitate to reach out to us here. We hope you enjoyed the time. Thank you.